Hello, good afternoon. This is Charles Kelly, Money Tips Podcast. Today I'm reporting on the housing market, which I think is in serious trouble. You're going to hear lots of conflicting reports in the newspapers and on YouTube. Other people are saying, no, it's going to be a soft landing, it's going to go up again. But I think it's in deep trouble. Interest rates are still rising and are expected to go up again. BuytoLet properties are no longer viable, and there's other reasons why I think with the failing economy, why I think we're going to see another property crash, certainly if not a crash then a correction. I'm looking here at an article I just saw yesterday in the Evening Standard. Our mortgage was $400 a month and now it's £2,000 a month, and this is a young couple. I don't know if you can see them here. They're trying to buy their property, and it's unbelievable how much things have gone up by. Other figures which I've known about for a while: average fixed rate mortgage, the average fixed rate mortgage, an increase of 2.59% just 2 years ago. So it's now at 5.85 now, 2.59 2 years ago. The number of residential buy-to-let deals which have been pulled in the last couple of weeks. Buy-to-let deals have been pulled, 800. 3 times the cost of household debt is set to treble this year thanks to mortgage repayments at their highest level since the financial crisis. And the other startling figure is 1 million, the number of homeowners whose fixed rate deals are set to end in the next 6 months. That's a million people a month will end their fixed rate deal. Most will have to face an average rise in repayments of, it says here, £5,000. I can't believe this. It must be a year. £5,000. So that's an annual rise. So it's 1 million people a month coming off of a fixed rate. I don't know whether that includes the buy-to-let people, but it's a lot of people who are going to be faced with trouble. I'm getting emails from people saying they can no longer afford their mortgage deal. It's just jumped and jumped and jumped. Some for other reasons. You've also got inflation as well. Don't forget, we've got near 10% inflation. We've got 20% food inflation. Don't forget. And this dam been blown up in Ukraine has now flooded a whole region the size of half of Wales. It's going to be flooded with water, ruining all of the wheat and soy crops that would have been harvested. I mean, this is the time of year when you expect sun, and it's harvest time soon, and these have all been destroyed and flooded. So I would stock up on your pasta and bread, because I think we're in for more trouble ahead on the inflation front, because you can see food inflation, which pushes up the average inflation. Food is not the whole equation, but it does make a big difference to the average inflation. In fact, in the UK, you can see they've said inflation is 8 point something percent, but food inflation is 19%, and the real inflation is higher, because I think they've dabbled with the figures there in the last few years. But I think the housing market, not only in the UK, but in the US and many other countries worldwide, perhaps Australia, perhaps countries in Asia, I've just been reading about Vietnam today, is in problems as the economy slows. In fact, I've read in Vietnam this morning that something like 23 major property companies have gone into liquidation, gone bust. And there's a big Singapore fund out there. These big funds are looking to maybe take over some of these properties from these properties. But I was there a few years ago when there was a massive property boom, and everyone said, no, the market can't go down here. Everyone thinks the market can't go down in their country. Philippines was the same. And there's massive booms in you can see these high-rise blocks going up everywhere in old cities and old towns. And people there thought it's never going to end, but things do come to an end. I've lived through recessions. I've lived through property boom and busts many times in my life, and I've seen what can happen. And forget about demand. It was, the demand's there, but there's always been demand. I remember when I was trying to get my first flat in London, and the demand for properties was so hot that you had to ring the agency or turn up at their doorstep in Oxford Street just to get considered to go and do a viewing. It was that bad. If you didn't call up every day, they would forget about you. So calling and calling every day, calling, popping in, because I worked near there at the time, and it was packed. The office was always packed full of people. And eventually they said, well, there's this room we've got in Kilburn, and it was a horrible little room in a place where you're sharing with the landlord, and he was a horrible person. It was terrible. But that was all they had. Eventually got out of there and got something else. But there's always been a mad dash for properties. There's always been a demand. But you can, and incidentally, after that period, about, I say, 2 or 3 years later, I bought my first property, and the demand was still there and everything was mad. And then it slumped, for a few years, and then it went up again. And then a few years later, there was a bigger problem. That was the end of the 80s, end of the party, if you like, crash of a lifetime. That was really bad. And then the property I bought at the end of the 80s, it took me 6 years before I could even sell it again for what I paid for it. So don't tell me about demand and all this sort of stuff. Property crashes come and go with the economic times. And we know that the country's printed or created 700 billion out of nothing, and America's the same or worse. So that's contributing to inflation, it's contributing to problems, and yet the economy here is still not booming. They say we're not in recession, but many people know that they're in recession. They know what's happening. Yes, you see conflicting figures. You see, well, okay, employment, a record number of people are in employment at the moment, which is good news. And London is busy again with people coming back to go out and that sort of thing. But I think a lot of young people have kind of given up on the dream of owning a property and just saying, well, look, we're going to live for today. We're just going to live our lives. We're going to travel. We're going to backpack. We're going to go out. We're going to spend, and forget about owning a property. Even forget about owning a car. They'll just hire a car when they need one. So I think a lot of young people are changing their mindset in that way. Whereas when I was their age, I was saving for a property and not going out, not spending. Maybe things have changed. Not everybody, but it's just a trend that I have noticed. Let's look at some other figures here. As I said, we're seeing higher rates of interest and landlords selling up. This is not just anecdotal, this is fact. Landlords are selling or looking to sell. I'm an online estate agent, so I know I get landlords approaching me, and some of them are expecting more than they're going to get for these properties. It's just the way it is, and that's unfortunate. I've had other landlords approach me saying that due to the higher rates of tax that George Osborne imposed on them, this Section 24 rates of tax, that their deal is no longer viable. In other words, their mortgage has gone up, their mortgage rates have gone up, but in addition, they're not getting the tax relief because they're higher rate taxpayers, which doesn't take a lot nowadays. It's like 50,000, you're into higher rates of tax. And because their property is not in a limited company, they're now, they're in deficit basically, because the higher interest rates and not getting tax relief and still paying out costs means that their buy-to-let is no longer viable. Yes, they can move it to a limited company, but that could involve capital gains tax and stamp duty. But I put a video here. If you ever look at a video that I did a couple of months ago, transfer property with limited company without paying CGT or stamp duty. Have a look at that video in the link below. Now there's another problem. I'm going to show you this clip of that the Financial Times reported that bond yields, they reported rising bond yields, and food prices are set to soar again. So the bond yields, I'm not an economist, I'm not an expert on bonds, but we saw this during that crisis during the mini budget, remember last year. Well, the bond yields have gone up again to 2008 levels, and maybe that's because the market is factoring in higher interest rates, or maybe the market is feeling that they just want a higher rate for the bonds, for the money they're lending to these governments. But when bond yields go up, the value of those bonds go down, and that's what caused 3 bank failures, or contributed to 3 bank failures in America recently. So I want to go to another subject now. Is the buy-to-let market dead? Well, yes and no. Certainly the deals that I'm seeing don't stack up anymore. They don't wipe their feet with higher interest rates. I've been offered properties which, with pretty good yields. I mean, the agent said, well, this property is, I think, $450 and the rent will be just under $2,000 a month. So you think, yeah, that's a pretty good yield, right? $24,000 a year rent. You're paying $450. It sounds a pretty good yield, right? But if you think, well, if you look at the borrowing cost on that at 5 and 6%, it doesn't add up anymore. It barely covers it. And then you've got a service charge on the flat they're offering as well, a couple of £1,000 a year. It just doesn't add up. Another deal he offered me, I think it was 500,000 flat, good 2-bedroom flat in Fulham. The service charges weren't so high, and the rent on that was something like 30,000 a year, maybe 30,000 a year on that. And but then you look at, say, 500,000. Say you borrowed 400,000 at 6%. Well, that's 24,000 a year. That's just interest only, and that's before you've added in your repairs, your service charges, your ground rent, your insurance, agency fees, maybe management fees, all these sorts of things, and it just doesn't cover it. In fact, you could be in deficit, and your yield could be negative if you take into account all of these factors. So. And that, of course, that's in London on London properties. A lot of people are still getting yields up north if they go up to the northeast and places like that. And a lot of people are getting yields by converting these properties into HMOs or holiday lets. But don't forget, holiday let is a different kind of mortgage. You're not supposed to get a BuytoLet mortgage and then run it as a holiday let or even a HMO. And I'm getting emails from people saying they're struggling to get HMO as a first-time buyer, HMO mortgages, because the lender's got to approve a multi-let property. It's a different risk from, say, a single let. Same thing with holiday lets. And of course, in holiday lets, we're seeing towns starting to look at restricting the amount of holiday lets they will allow in their picturesque village, because they're saying all these landlords, all London landlords, are coming down buying our properties, and then they're half empty most of the time in the winter. And then, people are coming and going, blah, blah, blah. In London, it's already restricted, but I think we could see other cities restricting that. I mean, it could be that the hoteliers don't like all this competition. I don't know. But definitely people in towns are a little bit put out that prices are going up, the locals can't afford to buy, and then landlords are coming in with holiday lets. But that's another subject. But what I'm saying is the ordinary buy-to-lets, which look great when interest rates were 2.5–3%, are not looking so good at the moment because interest rates have sort of doubled. We've also seen a lot of lenders pulling rates in the last few weeks. It even made the news. The news were even talking about the BBC, that all these thousands of deals were pulled in the last week and then reintroduced at higher rates. Again, that the lenders are factoring in higher interest rates, so that is definitely making a big difference. Okay, so do check out some of my other videos. More misery for property buyers as bank rates rise again. We've seen in one of my other videos how the Nationwide have shown that I think 7 of the last 8 months where property prices are falling. Now you might see other figures saying, oh, property prices have risen, but it depends on what level you're looking at, what time scale you're looking at. Yes, year on year they may have risen by a couple of percent, but that's nothing compared to what it was during that sort of 2021 period. So month on month the deals are falling down. I mean, the prices are falling according to Nationwide figures and the official Land Registry ONS figures. So don't believe everything you read, even from Rightmove, even from people trying to talk the market up, because obviously some people have a vested interest in talking the market up. So, right, will the market crash? I think it's quite possible that the market will crash and the stock market will crash, but, and the big but here, it depends on what the government do, depends what stimulus they put in place, depends what they do to try and rescue the situation. At the moment, they're not doing a lot, especially for landlords. They're kicking landlords in the teeth. They're just pushing them down there, and landlords are about to put up with extra legislation. Now this Renters Reform Act, which will make it more difficult to evict tenants, and will allow tenants to demand to have a dog or a cat in the house. No, thank you. So a lot of people are saying that, no, thank you. I'm out of here. I'm selling my property. I'm just getting out. The problem for those people is how they're going to get a yield on their money, because the banks are certainly not paying it. But that maybe is a subject for another video. So I want to talk to you about something else now, and that is, can you develop what I call the millionaire mindset? Now, it's not what you think. A millionaire mindset is not just having a flashy watch and a car and gold and diamonds dripping off you and driving an expensive car that you can't afford. The millionaire mindset is very different from that. But I want to show you in a free webinar that I'm doing on Wednesday night at 8 p.m. not only how to survive these coming turbulent waters, but how to survive and thrive in any depression or recession. So how to get control of your finances, get control of your spending, and then how to invest for the future so you can really develop that millionaire mindset and work towards financial freedom, which I think everybody wants that. They want to be financially free, financial security, whatever you want to call it, they want that. So I want to help you get control of your money on my webinar this week. So click on the link below and you can register for that webinar. 3 steps to successful money management and financial freedom. Check it out now, and I'll see you there. So thanks for listening. I'm sorry it's all a bit doom and gloom here, but I'm telling you it the way it is. I'm not just going to sugarcoat this. I'm telling you the way I see things happening based on my past experience, based on what's going on at the moment, and based on anecdotal evidence I see in the marketplace every day. It's not going to happen immediately. Property, declines take a while to come through. But I think it definitely seems to be happening unless the government does something dramatic to change things. Anyway, I'll see you on my webinar, 3 steps to success money management and financial freedom. See you there. Bye for now.